Welcome to Odessal Associates, Accounting and Finance Tutors. Today, I want to shift a little from the major accounting topics. It's been quite some time that we posted videos. This is because we had a full video that we're editing that we've not been able to conclude the editing. But we have been doing some online videos, and I'm sure you've been watching them. Today, I want to shift a little from the major accounting topics that we have been doing and to talk more on general business finance. This is because my audience have told me that I should also come up with something that will help them and not just my students. So that's why I am coming up with this. I want to look at common accounting mistakes small businesses make and how to avoid them. I'm going to look at 9 different mistakes, which may not be that different from each other because they connect. The first one is inaccurate financial records. The second one is mixing personal and business finances. The third one is poor cash management. The fourth one is inadequate accounts receivable management. The fifth one is failure to plan for taxes. The sixth one is ignoring small transactions. The seventh one is neglecting reconciliation. The eighth one is do it yourself accounting risks. Do it yourself, DIY accounting risks. The ninth one is not conducting regular audits. So these are 9 common mistakes I would like to talk about. But however, today I'm going to discuss only 2 as we continue in that series. If time will permit, I'll discuss more than 2, or the other ones will come in subsequent videos. So we want to look at inaccurate financial records. Of course, when we talk about inaccurate financial records, it means that our financial record is not correct. We are not recording our transactions the way we ought to record them. The mistake we make is failing to keep accounts and up-to-date financial records. This will lead to errors in financial statements and potential legal issues. It will lead to inaccurate expense categorization, and misclassifying expenses can distort financial statements and lead to issues, a lot of issues. So we want to look at actually how does this actually cause a problem to businesses. Now, we are going to look at the financial, operational, legal, and reputational consequences of keeping inaccurate financial records in a business. Let's look at financial effects. Misstated profit or loss. Errors in recording revenues or expenses can make profits appear higher or lower than they actually are, misleading management and investors. When we are unable to get accurate record, our statement of profit or loss will not be correct. And this is basically what both the owners and other people use to test the profitability of the business. So if this is wrong, if this is not correct, it means that the profit that is reported will not be correct, and it will lead to wrong decision making, both by management and by investors. A situation where you think that you made 500,000 naira profits when actually you are making a loss, or you are making a profit of 200,000. Your budgeting and everything will be based on what you recognize as profits. I can remember a time when we were selling phone gadgets and accessories. There was this lady that was always coming to buy cards from us. And then I asked her, you've been buying this card. How are you coping? Because the price increased. And it was at that time, there were phone shops where people would go and make calls and pay money, 50 naira to make a call. And then it came down to 30 naira, it came down to 20 naira. This woman continued to charge 20 naira. Meanwhile, the data plan she was on was 25 naira. And as he was doing this, she didn't know that she was making a loss. She was still calculating she was making profit until when I asked her. After explaining to her, she wept because she's been spending more money than the money she was making. So this is one of the things. She will misstate the profit, thinking that he was making profit, meanwhile he was making loss. And that was why she was continuing to buy the data plan, even though it was not profitable to her. So this is what inaccurate financial recording will lead to. This is very much impactful on small businesses. The next financial effect we're going to talk about is poor cash flow management. Inaccurate records can hide liquidity problems, leading to cash shortages and inability to meet obligations such as payroll or supplier payments. So, because you did not keep correct record, it will affect your cash flow management. Just like the story I told earlier, you think you are making money when you're not making money. So you will not be prepared. By the time you have you have spent all the money you have on poor businesses that is only generating losses, you will not have the liquidity to pay your workers and all those things. So it becomes a problem. But if you have accurate record, you'll be able to know how much cash you have, how much cash you are expecting to come in, how much cash you can pay, what you can borrow, and what you can keep. So definitely cash management is very, very important in business, both big and small business, as we are going to discuss poor cash management in its entirety when we go down. The next one is wrong tax payments. You can either overstate the amount you pay in tax or understate the amount you pay in tax if you keep inaccurate record. When you overstate, the revenue will collect more tax than they should have collected. And you and I know that to collect our money, overpayment from revenue is not easy. And if we underpay, we also know that we are going to pay not only the amount that we underpay, but we'll pay penalty and interest on the underpaid amount. So this is why we must keep accurate record so that what we are paying in tax will be the right amount. Inefficient budgeting. When past records are unreliable, future budgets and forecasts become inaccurate, leading to resource wasting or understatement. Of course, everyone knows that budgeting is based budget is based on past records. If you say, let's look at sales, you've been selling 50 units of a particular product. When you are doing your budget, it's either you budget for that 50 units or you look at the condition of tomorrow and either increase it by a markup based on what you have been selling or reduce it based on what you have been selling. If the record is not accurate, it means that the base figure that you are budgeting with will be wrong. Therefore, the entire budget will be wrong. When you are making a sale of 300 units and your record is 400 units, your budget will be based on that 400 units. And mind you, it is your sales budget that drives quite a lot of things, even the expenditure. So when this budget is wrong, it means that You will also have an inaccurate budget, which will lead to resource wastage or underinvestment. That is the financial effects of it. Then we have operational effects of having inaccurate accounting records. Faulty decision making. That's one of the operational effects. Management decisions, expansion, pricing, investments, etc. depend on financial data. Inaccurate information leads to poor strategic and operational choices, just like I explained in the budgeting. Because the figures you are relying on are wrong, the decisions you make will also be wrong. In management accounting, information is provided to business managers to help them make decisions. And when the information that is provided is inaccurate, the decision they will make is also inaccurate. And when decision that is made is inaccurate, it will either lead to loss or something more drastic in the business. So that is one of the effects. Ineffective cost control. Without correct data on costs and revenues, it becomes difficult to identify unprofitable products, services, or departments. Our story highlights this very much because you don't have accurate data on your costs and your revenue. To control costs becomes difficult. There are situations where you spend based on the fact that there is money. So if you reported that there is money without knowing that this money is not money from the business, but money that was borrowed for a particular thing, when that thing that the money was borrowed for calls, you won't be able to respond to that call because you did not keep accurate record. Inventory problems. Inaccurate accounting for inventory can result in overstocking or stockouts, disrupting production and sales. Of course, you know that our sales are based on the stock we have. So if our stock is not accurately recorded, our record will be saying another thing when the physical stock will be saying another thing. And when we rely on the record, at the end, we will not be able to meet up demand in the case of stockouts. On the other way around, we might be overstocked that inventory will become obsolete or prices will go up or lower as the case may be. So it's always right to have the right inventory. And if we have accurate record, we'll be able to maintain the right inventory. You know, setting targets, parameters, and all the rest are based on the accuracy of our record. Legal and regulatory effects. When we have inaccurate record, there will be a problem of compliance and there will be penalties for non-compliance. Inaccurate records may breach accounting standards, tax laws, or corporate regulations, attracting fines or legal action. Of course, both small business and big businesses pay tax, and there are form of regulatory mechanism that they go through. And if they have inaccurate record, they may not comply fully or they may not comply at all. And this will lead them to paying penalties and interest as the case may be. Audit issues. External auditors may issue qualified or adverse opinion, reducing stakeholders' confidence and possibly affecting the company's credit worthiness. Then fraud risk. Poor record keeping provides opportunity for embezzlement or manipulation of figures, leading to financial losses and legal consequences. So when we do not keep the accurate record, the people working for us can steal our money and we'll be able to find out because we don't have the correct record. But if we keep good record, we'll be able to find out when our employee are trying to play a fast one on us. Reputational effects. Loss of stakeholder trust. Investors, creditors, customers may lose confidence in the company's integrity and reliability if they found out that your records are not reliable, they are not straight. So nobody will rely on you to damage business relationships. Suppliers and partners may withdraw or tighten terms due to concerns about financial stability. Difficult in raising funds. Banks and investors rely on accurate financial statements to assess risk. Inaccuracy can lead to loan denials or unfavorable interest rates. So if our records are not accurate, we might find it difficult to borrow money, to raise funds, even from friends who knows that our records are not reliable. They will not want to give us money. Long-term strategic effects. Stunted growth. Because of all these things that I've listed, the business will have a stunted growth because of inaccuracy. Persistent inaccuracies hinder effective planning, making it hard to expand or compete effectively. Then risk of business failure. This is the poorest of all. At the end, the business might fail. Continuous poor financial management and lack of accurate data can untimely lead to insolvency or closure or bankruptcy, as the case may be. Inaccurate financial records distort the true financial position of a business, leading to wrong decisions, loss of credibility, regulatory penalties, and untimely financial distress or failure. In order for us to avoid this, there are things that we need to do. First and foremost, we need to hire an accountant. It may not be a chartered accountant that you have to pay so much, but an experienced accountant that can keep your record properly in such a way you'll be able to keep the correct record. You can use an accounting software. If you go to supermarket, you see there is a computer, and when you buy something, they scan it, the thing appears in the computer. Those ones, you don't need an accountant to do that. Anybody can do that. And at the end, you can print your records, financial position, and financial statement. We must implement a reliable accounting system and ensure regular backups of financial data. Consider hiring a bookkeeper or accountant to maintain accurate records. One thing I want to say is that even if you have somebody you have hired, you must insist that this person is entering your record. And once in a while, hire somebody from outside to come and check whether the records are properly kept. The risk of not keeping accurate financial record is too much for you to close your eyes on. If you love your business, ensure you engage an accountant that will help you. If you love your business, ensure that all your records are properly kept. If you love your business, ensure that you do the right thing in bookkeeping. Bookkeeping is the soul of business. Bookkeeping is a life of business, especially small businesses. If you did not take adequate measurement in bookkeeping, definitely that business will not survive. Even if it survives, it will not give you what you want. It will not make you to become that big person you want to be, that big business you want to be. Remember that all these big businesses that you are seeing today started from small business before they become big business. I have spent quite a long time, so I won't be able to take the second course in this video. I'm going to do it in another video. So let us take this one and wait for the second video to come. That second video will be mixing personal and business finances. Please, my viewers and my subscribers, you should do well to share this video, should do well to like this video, should do well to follow us on all our social media handles, and then ensure that you recommend to your friends to subscribe If you have not subscribed, please subscribe. Thank you very much.